The conflict between Iran, Israel, and the United States in early 2026 has affected Nigeria and Kenya, causing higher fuel costs, supply chain issues, and security concerns. Kenya plans to use its petroleum levy, for example, to limit pump prices, while UK advisors are suggesting finding a way to capping profits of gas companies in the UK. There are questions about whether general subsidies might return as politicians come under intense pressure ahead of elections, depending on how long the inflationary pressure lingers. Senior economist David Adeoye comments on the effect on the Nigerian economy and citizens.
What has happened in recent weeks has caused major disruptions in the transportation of energy products, and ultimately is expected to lead to a slowdown in global economic growth for the year 2026. In many markets already, there is a shortage of key energy commodities and some agriculture inputs, especially fertilizer. Now, many refineries are not getting the feedstock, which is crude oil. Also, a number of liquefaction plants are not getting their feedstock, which is liquefied natural gas. Now, in this case, what we are seeing is there's continued shortage on one hand, and there's rising prices, and both rising and unstable prices of crude oil. Now, there is disruption of other value chains outside of crude oil. All of this is working towards a weakening of demand across industries at the same time that prices are rising. So we could see higher inflation in many countries, and already a number of country authorities are working to see how they can manage these impacts, both for the citizens and for the stability of the macro economy in their countries. So we've seen Kenya made announcements around using its petroleum development levy to contain the rise of price in petroleum products. Indonesia already announced moves to manage demand and see what can be done. So they've introduced a 4-day working week for government workers and have advised the private sector to do something similar. Now, what can Nigeria do? For us to make any consideration of policy, we need to understand what the situation is. So Nigeria today operates a deregulated downstream market. The government does not fix the price of any of the products. Now, but nevertheless, because we have what we can consider an energy emergency, there is an economic imperative for the government to intervene either from the supply side by way of price intervention or from the demand side by way of altering the need for transportation. So as we speak, the dominant fuel for industries in Nigeria is diesel or AGO. And the dominant fuel for transportation, especially for commuters, is still PMS or premium motor spirit. So options for the government include both demand side options to say, okay, how do we manage the demand? Do we reduce the length of the working week for the time being? Do we reduce the need for people to move around and so on? Those are options. Now, as a country, because of our history, we do have to be careful with any form of subsidies, especially subsidies through the supply chain. Now, but now this does not rule out the possibility for government to consider subsidy for its own workers or subsidy for employers and so on. But what is important is, at this point, it's important to show a measure of sensitivity and a measure of consideration, especially given the economic situation that many Nigerians are faced with.
Hello, this is Global Business Insights, where we look at the world from a business perspective and bring news, views, and analysis that helps to get up to date on the context. Headlines continue to sour the mood for markets as G7 foreign ministers meet today. US Secretary Marco Rubio got everyone's attention by repeating yesterday that the Russia-Ukraine war is not America's war and its priorities may reflect that reality. The main issue has to be what to do about the future of the Strait of Hormuz. Europe is also saying Russia is supporting directly and covertly Iran against America and is calling for restating sanctions on Russian oil. All over the world, nervous traders, investors, wealth managers, and bankers are working weekends and having long client meetings as the tough challenge stems from uncertainty on how long the US-Israeli war with Iran will go on and what it exactly means for oil prices. After the US gave its 15-point peace plan, the Iranians are said to have responded with 5 conditions before any talks. These include a halt to all US-Israeli hostilities against Iran, a halt to attacks on its regional proxies, concrete guarantees that none of these hostilities are renewed, full war reparations, and of course, international recognition of Iran's sovereign control over Hormuz. No surprises, Trump extended the deadline for the US to bomb Iran's energy infrastructure to April 6th, but that is not calming markets already on edge, as volatile oil markets go up over $110 per barrel for Brent. The extension, according to Trump, was at the request of the government of the Islamic Republic. It seems the only thing that will move markets now is unambivalent progress towards reopening the Strait of Hormuz and broad, sustainable de-escalation of conflicts in the region, noting the uncertainty will not completely dissipate. Oil producers are doing all they can to augment supply through other trade routes. In Saudi Arabia's Al Madinah province, exports runs from Yanbu, a key refining and petrochemicals hub, and major Red Sea port are hitting record levels of around 3.4 million barrels per day in March month to date, with flows rising to 4.7 to 5 million barrels per day in the week beginning March 23. Apart from the obvious new limitations on supply and attempts to bypass restrictions, analysts are also watching measures of demand collapse as consumption drops in response to high energy prices by reducing travel and conserving fuel. Also of interest are investor actions to build portfolio resilience and diversify portfolio incomes. To other stories, a postponed summit between President Donald Trump and Chinese leader Xi Jinping is back on the table and will hold in Beijing on May 14th and 15th. The new date could be seen as signaling that the war would have ended by then, allowing discussions to focus on trade win-wins and other mutually beneficial matters. China today, not to be caught in a defensive mode, announced its own investigations into US trade practices, retaliating against similar probes by the Trump administration. You could say both sides are building a negotiation armory. Analysts are not hopeful of much beyond the preserving of the status quo in a year already loaded with geopolitical surprises. Still on China, industrial firms saw their profits surge in the first 2 months of this year as officials continued efforts to contain the fallout from industrial overcapacity and low consumer demand. Industrial profits jumped 15.2% from a year earlier in the January to February period, extending a sharp rebound from a 5.3% jump in December. In the UK, the total volume of goods sold online and in stores fell 0.4% in February, reversing a previous month's 2% gain. It was also the first drop in 3 months, but not as bad as the 0.7% decline expected by economists. The streaming giant Netflix yesterday adjusted its pricing structure, with all subscription tiers up by at least $1. Netflix says it has been investing heavily in its content, including new ventures, the live event space, and into video podcasts. Prices have been constant since January 2025. Netflix, in its latest earnings report, said it expects to spend $20 billion in 2026 on content, up from $18 billion in 2025. The much addicted viewership can also expect to see higher pricing as investment to fend off competition continues to mount. And talking about addiction to social media apps, this week Meta and Google disagreed with the court ruling and plan to appeal the decision that a teenager's mental health was hurt by addiction to its apps. Google also argued that the case mischaracterized YouTube as a social media site rather than a streaming platform. Meta shares closed down 8%, hit by the general risk-off mood driven by high oil prices and worsened by the recent major court losses. This is on top of concerns with AI monetization delays amid huge investments and the recent diversifying from virtual reality technology and decline in metaverse bets. Although the $6 million in damages is just a slap on the wrist, it sets precedent that exposes Meta and Alphabet to multiple consolidated lawsuits involving thousands of users. Should juries address social media addiction similarly to how they have approached harms caused by tobacco companies, these technology firms could face significant legal challenges. In 1998, cigarette manufacturers were required to pay $206 billion to state governments as part of several multi-billion-dollar settlements. These payments were intended to help cover healthcare expenses related to smoking. However this goes, we can in future expect stricter policing of sites, adding to costs that will be passed to users and possibly firmer restrictions and raising of the minimum age for access to apps. As the big tech firms choose their battles with all eyes on the many ethical issues around AI, as regulators zealously build their case to make AI safer for users, especially the younger population. Meanwhile, the US ambassador to the European Union, Andrew Putzda, warned that excessive regulation and fines will put them at a disadvantage in the AI race. He added in an interview today that the EU needs to dial back regulation of US big tech companies if it wants to be part of the AI economy. European stocks fell as G7 finance ministers met in France. A lot on their plate. Asia-Pacific markets traded mixed following a volatile session as the prospect of peace in the Middle East remained at best murky amid all the contradictory messaging from the US and Iran. Wall Street is again on the back foot. The Dow Jones Industrial Average sank and fell into correction territory as Brent topped $110 per barrel. Well, that's all we can take on this special edition of Global Business Insights. This is Adeoye. Enjoy the weekend. Do not forget to subscribe and hit the notification button. Bye-bye.